leave it on their balance sheets and then just let it roll off, in 10, 20 years time when the maturity goes up? Or does it, again, devalue the dollar, which causes inflation? Are we going to start to see outright inflation? A lot of currencies, this is how they get destroyed. We just have to look at World War I in Germany, where people were paying for their meal when they went out to a restaurant before they ate, because by the end the meal would be more expensive because of inflation. We've seen in Zimbabwe where there's I think $1 billion note, won't even buy a loaf of bread. We've seen it in Argentina, but we just don't expect these things in a developed country. But how far can they push this before we kind of reach a tipping point? Anyways, that's that. Another thing I've talked about is the market is based on price to earnings. I mentioned earnings now have been flat for quite a few quarters, and of course they're going to drop drastically over the next 2 quarters, and that's just going to bring the price down in the market, which it has already, but I don't think it's valued, still came down to the point that earnings are going to drop. We're also seeing a change in what companies should do under Milton Friedman, famous economist. His philosophy was to always optimize the profits of a corporation. But they had a roundtable last year where they looked at the purpose of a corporation and maybe taking more stakeholders into account, not just the shareholders. So that means the workers, the government, the public, and maybe now there will be more of a shift away from just earnings itself. And I can show where we were at a peak of corporate profits to GDP, and so there's corporate profits. We can see it's been flat now for looking about 8 quarters, and sorry, I can't find that chart where it's a percentage, but the percentage of profits to GDP is at kind of an all-time high, and I only see that kind of coming down now, which again means less earnings to support where the market is. Plus, these corporations now that are going to, where their debt has gone to BBB or junk, and if somebody doesn't buy their debt, they're going to be basically insolvent and go out of business. The Fed is going to come in some cases, and buy that debt. And one of the policies that I've read about is if they do that, and even if the government takes an ownership, like they did with GM Motors back in 2009, and sold the shares as GM came back, out of the recession, that they're going to ban stock buybacks, which I've talked about in many videos, which I've said has basically been a Ponzi scheme for the rich. So that's another thing. If they can't do stock buybacks, which saying here from Goldman Sachs again, that they expect a 50% decrease in stock buybacks over the next 12 months. So that's another thing that's been propping up earnings, and a lot of companies now, even if they don't need the financing from the Fed, it's just not going to look good if they continue doing that, rewarding the executives through, stock options, and really sacrificing the book value, which I'll get into later on two stocks that I shorted last week because they've been using this type of policy. So again, on the retail side, we know that's a complete disaster and only getting worse. We're using the word furlough now to make it sound not quite bad, instead of being laid off or fired. But Wall Street Journal said 130,000 workers at Macy's are basically being furloughed. And we don't even know if something like Macy's is going to survive. So just like the brokers telling everybody, hold stocks, everything will come back, in the long term. But as John Maynard Keynes said, one of the famous British economists said, in the long term, we're all dead. So again, that's why I think just holding cash or looking at some possible short positions or credit positions with options is still the way to go. So then I have talked about gold. So I did buy a company I'll mention shortly, but so with negative real rates, that makes gold more positive as an asset to hold, because if you're actually going to get a mortgage and at the end of it you're going to get back less than you originally invested, then you look at different asset classes, and gold still is an asset class. So it makes, gold doesn't pay a dividend or anything else, it's just a metal that sits there, but it has gone up over thousands of years. So the negative rates, expanding central bank balance sheets, it's a safe haven asset, and the potential for higher inflation, massive government stimulus, which I've talked about, are all potent cocktail for higher gold prices over the next 12 to 24 months. And this happened, we saw gold rally quite strongly after the 2009 financial crisis, and then it dropped off, not to a real low, but then it has been starting to trend up over the last year. But I'd also like to say that I hate gold stocks. Probably one of the worst investments you can make. They're typically not shareholder friendly. Gold prices go up, they get nice cash flows, the cash comes into the corporation, and typically what they do then is buy out another corporation or develop another mine, which takes huge amount of capital, and seldom do they ever return that money to the shareholder as a dividend. So I did buy Centerra Gold, which is CG.T, which I'll talk about a little bit more, but this is more just for maybe a 1-year holding, that type of thing. And I'll just typically watch the price of gold. So CT trades on the Toronto, I think it's around, if I can pull up a graph. Symbol CG. Here, and it was up to around $13, dropped down to about $6, and then I bought in here around $8.59. I just bought a small amount and haven't done a lot of research on it. TD had it one of their top picks with a target price of $14 within a year, and that would be about a 60% gain. But I don't always take TD price targets that seriously for resource type companies. They're very good for dividend type stocks. So this is a bit of a wait and see, but it does have a net asset valuation per share of $11.13, so it's trading below book value. But of course those assets aren't probably worth really that much if the gold sector or gold goes down a lot. It's not like you can sell Caterpillar equipment or something like that when, you know, if gold prices were to drop a lot. So I take that with a bit of grain of salt, but at least it is trading below book. And it does pay a small dividend, which is encouraging, but it's almost an insult. It's only 0.5% yield. So their overall cash price, like all in, including fuel, labor, all that, is about $1,000 an ounce. So there is big leverage on gold plays. I kind of want to see gold go through 1,700 before I buy any more. But say, for example, if a gold company breaks even at $1,000 an ounce, then when it goes to $1,100 an ounce, their earnings have gone up a huge amount, and then from 1,100 to 1,200, they haven't in effect then doubled their earnings because just doing the math. So if we see $1,700, $1,800, then a company like this, you know, could show some solid earnings. Earnings are